Hi, I wanted to make a short slideshow that reviewed net present value analysis. It's real important just to understand the logic here. What we're doing is finding the future benefits that come from a investment, whatever investment we're analyzing. We're going to compute those in terms of today's dollars, so we're going to take the present value of those future benefits and then we're going to subtract the cost. Now if that's a positive number, that means the benefits outweigh the cost, and so this is a good project. And we do this from the perspective of shareholders. We use after-tax cash flows. Those are cash flows that are available to shareholders. That means that a positive net present value increases the wealth of shareholders. An important thing to remember about these cash flows is they're after-tax, they're obviously cash flows, but they're also incremental. And the way I look at incremental is I think of the project or the company with this project, with this new product or whatever it is, and I compare it to the company without, and it's that differential. And you may say, well, that's just whatever the new product produces in terms of revenue and profits. That's not really true, because if a new product takes away from the sales of some existing products, that cannibalization has to be considered. So if we didn't do the new project, we'd still have those sales, presumably. So the cash flows that we should use in our analysis are the differential between with the new product and without. Now I want to go through two methods for estimating cash flows, and you have to be a little careful here about the line of the accounting statement that I'm using. So I say earnings before tax from this project product is $10,000, and that we have $3,000 of additional depreciation expense. And the tax rate's 35%. Now the first way, and probably the most straightforward way to estimate cash flows, is to create the bottom of an income statement and then add back depreciation. A couple things to notice. Earnings before tax is $10,000. The depreciation expense, $3,000, is above that. So earnings before depreciation and tax is $13,000. That'll be important in just a minute or two. So we have earnings before tax, or taxable income, of $10,000. We pay $3,500 to tax. That gives us net income of $6,500. We add back depreciation. We get a cash flow number of $9,500. So that's the bottom line there. Now here's the other approach, and using this approach, we start, instead of earnings before taxes, we start with earnings before depreciation and taxes, and that was $13,000. And what we'll do is we'll compute the after-tax value of that number, and then we'll compute the value of the tax shield from the depreciation and add those together. So earnings before depreciation and tax, $13,000 times 1 minus the tax rate, is $8,450. The tax shield from the depreciation expense, remember, it's a non-cash charge, and so the tax shield is just the amount that the $3,000 deduction will reduce taxes, and that's $3,000 times the tax rate, or $1,050. We add those numbers together and we get $9,500, same result as using the income statement approach. A couple things to keep in mind about cash flows. What goes in is pretty straightforward. The things that we didn't talk about were working capital investments. And the thing to remember about them is they go in and then we recover them at the end of the project. The way to think about this is, imagine that you are renting an apartment for the school year and you stock up on food. The last couple weeks you eat the food that you had stocked up on. You don't go to the grocery store, and some of your meals aren't too good, but you aren't spending any money. That's the recovery of that working capital. Sometimes there's tax consequences, and we have to take those into account. More important are the things that we leave out. There's three big things that have to be left out, or else we're going to misestimate our cash flows. One is allocation of overhead. So if you have a manager and that person's earning $50,000 a year, and they're going to dedicate 10% of their time to this new investment project, you don't allocate $5,000 of their salary. That salary is already being paid, and it doesn't affect the project, or rather the project doesn't affect the salary. Salary is going to be paid no matter what. A person would do something else if they weren't doing this. And that leads us to a sunk cost, because that salary is sort of a sunk cost. It's going to be paid whether we do the project or not. Other sunk costs include things like marketing research. That's a big one. Maybe technical analysis of a product to make sure it's going to work, that kind of stuff. If we're going to pay, no matter whether the project is accepted or not, those are sunk costs. The third area is a big one, and it's a little complicated, and I think I put an example in one of the slideshows, but those are financing costs. So we don't take out the dollar cost of, say, interest on debt. We separate financing decisions from investment decisions. So we make the financing decision, how much debt, how much equity, and so on. And that determines the discount rate that we're going to use. And so the financing costs are really included in the discount rate. To put them into the cash flows would be double counting. So no allocation of overhead, ignore sunk costs, and no financing costs. The second type of cash flow that we have to consider, the first one was these operating cash flows that we just looked at. The second type is initial investment. That's the cost of getting the project up and running. So we buy some machinery, we train employees, maybe we make a working capital investment, and we take into consideration any sort of tax incentive, say investment tax credit, production tax credit, and so on. In addition, if this is a replacement decision, that is, a new machine is replacing an old one, then the income from selling the old machine will offset some of the cost of the new machine. The third cash flow are terminal cash flows, and these are in addition to any operating cash flow during the last year of the project's life. We'll probably sell or scrap the machinery, and there may be tax consequences, so that's some income. We'll recover working capital, and there may be costs of cleaning up or reclamation. We'll add those to the operating cash flow from the last year of the project or product's life. I'm going to go through an example that demonstrates a lot of this other than working capital and kind of get that one built into this example. So what we're going to do is replace an old computer with a new one. We're going to sell the old one now for $600, but it has a book value of $1,000. And it has one more year of depreciation, and that's $1,000 a year. So we have 1 year of $1,000 depreciation left on the old machine. The new computer will cost $4,500. We're going to depreciate it at $1,500 a year over 3 years using the straight line method. We'll sell it at the end of year 2 for $800. And we think the new computer will improve productivity or allow us to do different range of projects or whatever. And it's going to increase earnings before depreciation and taxes, earnings before depreciation and taxes by $3,000 a year. Tax rate's 30%, discount rate's 12%. So initial investment, we sell the old for $600. The book value is $1,000, so we're taking a $400 loss on this sale. That $400 loss reduces taxes by $120. You could think of it as, if we had done this properly, we would have depreciated the old computer down to $600. So we would have had an extra $400 worth of depreciation, and that would have created a tax shield of $120. The total income from the sale then is a $600 check that somebody writes us, plus the $120 reduction in taxes, or $720 total. We're going to pay $4,500 for the new computer, and that means that the net cost is $3,780. That's our initial investment. During year 1, we're going to have earnings before depreciation and taxes, an increase of $3,000. We have depreciation of $1,500 for the new machine, but we had $1,000 depreciation for the old machine already, so the net depreciation from the project is only $500. We're going to compute the after-tax value of each of those using the second method that I showed you. So that's $2,100 for operating income and $150 for the tax shield, and I'll show you those calculations. So the $2,100, that's the $3,000 of earnings before depreciation and taxes times 1 minus the tax rate, or 0.7, that's $2,100. The tax shield from depreciation is the net depreciation amount times the tax rate, or $150. That adds up to $2,250. In year 2, same earnings before depreciation and taxes. Depreciation is $1,500. We don't have any old depreciation, so depreciation is that entire amount for the new machine. And we're going to get after-tax operating income, $2,100. The after-tax depreciation shield, $450. That gives us $2,550. Now to that, we need to add terminal value. So we're going to sell the computer after the second year for $800. The book value at this time is $1,500. So that's a $700 loss. So book value $1,500, sales price $8, loss $700. The tax reduction from that loss is 0.3 times 700, or $210. So loss times tax rate. And same thing, we could have thought of it as we need to depreciate another $700, and that depreciation tax shield would have been $210. We add that to the operating cash flow, which I have wrong here. It should have been $2,550, and that gives us $3,560. So let's go through the present value calculations now. The cash flows are $3,780. That's negative. That's an outflow of the initial investment. Year 1, $2,550. Year 2, terminal value and operating cash flows, $3,560. Take the present value of each of those at 12%. The net present value is the sum of those PVs, $1,334.80. And that gives us an internal rate of return of 36.5%. And I found that number using the Excel IRR function. So that's a real basic net present value analysis with tax ramifications, differential depreciation expense, and so on. Thanks a lot.